Hi,
Yep, yep.
everyone. Welcome to this AMA between CitaDAO and CreatorDAO. We have with us Joel and Ethan. Hey, guys.
Hey,
Hey,
Welcome to this AMA. We got a bunch of people from Creator, a bunch of people from CitaDAO, and let's talk about your project. Before we get started, they need to just do a quick legal disclaimer.
yep. So, for legal reasons, this is not investment advice, nor solicitation of investment or asking anyone to buy any investment product. And for practical reasons, we would also like to state that the CitaDAO token is not being sold by the project, and there is no CitaDAO token on the market today. So, with this, we'll get right to the AMA session. We are very excited to share with you our vision for real estate on chain, as well as a sneak preview of our upcoming POC in January 2022.
Likewise.
So,
Well, let's get into it.
yep.
Well,
Perhaps to start off, I would like to first introduce myself. So my name is Joe, and I have been helping institutions invest over 2 billion in real estate for the past 12 years. Previously, I was with CBRE, CapitaLand, and UBS Investment Bank. And over here, I have my teammate, Ethan. We like to go.
hey everyone. Yeah, thanks, Joe. So my name is Ethan. I've always been in big tech. I was with Uber. My last role before I joined full time with CitaDAO was actually running strategy and growth for Amazon. And I've seen the power of Web3, so I'm like totally convinced. So I made that leap, jumping from Web2 to Web3. That's it.
Yep.
very cool.
So
So, how was CitaDAO, the whole idea or the project, conceived? Where did it come from?
it kind of came from our experience actually. Just to go back a little bit into a short introduction. So my crypto journey kind of began back in 2017, 2018. At the point in time, STO was all the hype, and I was on the institutional landlord side, and we received many real estate tokenization proposals requesting that we tokenize our real estate by injecting our properties into their projects. However, none of them could actually give a proper answer when we asked how we could legitimately enforce our rights to redeem the real estate token for the underlying real estate. And I could never get a convincing answer as to how we could exchange that real estate tokens for liquidity in the secondary market. And this obviously sparked off some very exciting discussion among in the industry, and a couple of institutional lawyers and myself. We came together. We started brainstorming on legal structures that will legitimately confer the right to redeem the underlying real estate with a real estate token, just like how you can redeem the US dollar with the USDC. And it was back in October 2020 that we had a breakthrough. We came up with a structure that a prestigious law firm with more than a century worth of experience specializing in real estate is willing to officially issue a legal opinion to validate the legitimacy of the structure. We took this to a family office. The family office got the legal counsel to review it. They love it. They agree that it will work. They agreed to inject their portfolio of real estate to support the POC for this project. And that is how the CitaDAO project began. We subsequently reached out to members of the DeFi community, a couple of OGs and stuff, and invited them to build a DAO together. The response was overwhelming and very supportive, and it is just past the 1 year mark since the genesis of CitaDAO project. And we have come a long way, and I'm very excited to share with you our journey to introduce real estate on Web 3.0.
So I've been in the crypto space for a while, and I remember vividly in 2017, 2018, how, like you mentioned, all these real estate tokenization projects were all the craze. Now, what is CitaDAO in a nutshell, and how did all these projects fail to launch or fail to be successful until now? And how did now become the right time for CitaDAO to really become a success?
So that's a very good question. I guess at a point in time, I would say it might be a bit too early for tokenization. At a point in time, the crypto space was not what it is today. is still a very immature market. DeFi is not really a thing then, and I guess most of the as I mentioned, most of the crypto projects then they run into two key hurdles. The first is the regulatory hurdle, and the second is the liquidity hurdle. So that kind of sums up what the key challenges were back then. Obviously, there's also the other aspect of how real estate on chain yielding about 5% to probably 10% if you are good. It is not as attractive as some of the yield farms out there that or some of the token projects out there that is easily generating in excess of double-digit APY. So these are kind of the three key challenges that we see back then and even today. However, the landscape has changed significantly. So the first challenge of the regulatory hurdle, it is more unique to our project. We were able to develop a breakthrough solution to actually enable the real estate token holders to legitimately redeem the title deed with the real estate token. And this is important because with this now, your real estate tokens finally have a floor to the underlying, based on the underlying real estate price. And I guess that is important thing even for the institutional landlord perspective. Given that previously one of our key concerns was after we tokenize the project, and we have a bunch of token holders sitting in the project, right? Which are sharing the so-called title to the underlying real estate. And if we ultimately want to unlock liquidity by selling the underlying real estate or selling the token, that's not possible. We can't sell the real estate because we literally have to get approval from thousands or even hundreds of thousands of token holders. And by the time they give their approval, maybe the opportunity has passed. So that was really point number one, the regulatory hurdle. Back then, that was the challenge, and today we have kind of resolved. The second and third, which is basically the liquidity hurdle, as well as the yield hurdle. For the liquidity hurdle, there is more of a change in the landscape. Back then, DeFi wasn't a thing. The concept of yield, as well as liquidity mining, is alien to most people in the crypto community. Then it was all about ICO, IDO, IEOs, and nobody really understood what yield means in the DeFi space, in the crypto space. The landscape changed significantly this year with DeFi summer, and suddenly there's a mass adoption of liquidity mining and yield farms as a concept. And obviously with this mass adoption and understanding of how yield and liquidity mining work, we unlock the liquidity solution for the secondary market liquidity in the real estate space. Now you are able to actually exchange your real estate token for liquidity via your AMMs, for example, to unlock that elusive liquidity challenge that has been the bane of most tokenization projects since the 2017-2018 days. But that kind of left us with one other challenge to resolve, which is the yield farms. The yield on the real estates, they can't really compete with the yield farms in the DeFi community. Like I mentioned, if you're able to get even 10% out of the real estate, that's a very, very good deal already. But even then, you can't compete with the double-digit returns that the yield farms are offering. And that's something that's unique to our project too, because we took a unique spin to resolving that. What we have done effectively is to build sustainable DeFi yield farms powered by real estate globally, whereby we use real estate tokens as a way to farm yields on the CitaDAO platform. And we can go into details about that later. But I guess that I hope answers the question of why now, why today versus then.
For sure. We'll dive into that a bit deeper in a bit. But for those who are tuning in and just don't know what CitaDAO is at all, who are you guys, and how would you present CitaDAO in an elevator pitch?
So CitaDAO is a decentralized platform to create sustainable yield farms powered by real estate globally. And we aim to solve the lack of liquidity, access limitations, and lack of composability in the existing real estate ecosystem. We do this by creating composability with other DeFi primitives, DeFi projects that increase the use cases for the real estate tokens. Yeah.
Very interesting. And what blockchains are you looking at?
We'll be launching on the Ethereum chain for our proof of concept, but we are currently actively exploring other layer 1s and layer 2 for our version 2 release. In fact, we are in advanced discussion with one of the interesting layer 2 chain that we will be happy to share once we have firmed up the collab agreement.
Very interesting. Would be happy to hear what that is when it is time. And what is the main problem that CitaDAO is trying to solve?
So for the CitaDAO project, I guess, as you mentioned earlier, real estate is today is a very capital inefficient asset class. And today, the real estate lacks access, liquidity, and composability. Even though it's a 280 trillion market, a whole bunch of that capital is locked. That means money that's not doing anything, it's not earning interest, not being invested, not being used to drive the economy. Our plan is to leverage DeFi to unlock that capital. And we believe that by doing so, this will drive demand for real estate on chain, increase capital efficiency, and enhance the overall fair value of the real estate universe. In fact, we believe that in future, there will be two sets of prices for real estate. The price of real estate on chain and the price of real estate off chain. And we are convinced that the real estate on chain will have a higher value than the real estate off chain, simply because there will be more use cases for the real estate on chain, unlike the limited use cases for real estate off chain today that is constrained by existing limitations on how we can unlock the capital in real estate. So just to give you a simple analogy here, take the Apple iPhone, right? You have an iPhone today, and the iPhone have only 3 functions. You can call someone with the iPhone, you can send an SMS, and you could potentially take a photo of yourself, but you can't share that photo without physically sharing the phone with your friends. How much will you pay for that phone? Probably $200, $300. But then enter the App Store. And with the App Store, it invite developers to start creating different apps offering different functionality on your iPhone. Today, your iPhone can do more than the 3 items I mentioned. You could surf the web, you could go on social media, you could make a bank transfer, play games, watch movie, yada, yada, yada. So there's so much functionality you could unlock with the App Store. And suddenly your iPhone today is worth a couple of $1,000 because of the increase in use cases that was delivered by the App Store. Likewise, this is what CitaDAO will do. We are the App Store for real estate, and we will be increasing the use cases for the real estate on-chain. In fact, in future, we believe that the value of real estate tokens on-chain will increasingly be driven by the use cases for the real estate itself, real estate tokens itself, and the underlying real estate will only contribute only a fraction of the actual value of the real estate. And because of that, we believe real estate today is a very traditional asset class that's ripe for disruption.
That's very interesting. In some ways, in my mind, it parallels some of the use cases that are unlocked with fractional for NFTs, where they have very high value NFTs. They fractionalize them. People buy a fraction of the NFT. That increases the value of the NFT itself. And then people use the fractionalized pieces of that NFT, for example, of the famous Doge meme of the Shiba Inu dog, and they can yield farm with it, and they can do all sorts of different things that are unlocked because of this new structure. Would you say that they are kind of similar?
Precisely. I mean, there was a tweet by Mark Cuban recently, right? And he said that, look, if I were to take a bank mortgage today, I have to fill out a whole bunch of application form, answer a whole bunch of questions that are irrelevant to the mortgage itself, and ultimately I get a bank loan in maybe a couple of days if I'm lucky. Otherwise, 1 month later. On chain, I just have to deposit my crypto token into a lending protocol, and out comes the USDC in 2 minutes, right? So this is one example of how Web3 can unlock efficiency, capital efficiency in real estate. Imagine with the real estate token today, I mean, if you have a legal title and mortgage, and you try to take a bank mortgage, it will take you probably a month for the money to come out. Now imagine you have a property that is fully paid out, 100% payout, and with this property that's 100% payout, maybe someone told you about Bitcoin or Dogecoin or Ethereum yesterday, and you decide that, hey, I'm going to ape into this crypto assets, right? And the price was trending. They're all going to the moon, and the only thing you have is this piece of property you have that has zero mortgage on it, and you want to unlock equity on that. So imagine calling up your banker 3 a.m. in the morning on a Sunday night and say that, hey, I want to mortgage my property. I need the money tonight, literally, right? To ape into the crypto universe. I would imagine a banker would just tell you to just, off, right? And but imagine with the real estate token, in a similar scenario, now you can take these real estate tokens, you kind of deposit into one of the lending protocols. Out comes a USDC or USDT or whatever, and within 2 minutes you're into your new position and riding a Dogecoin to the moon, for example, right? These are the kind of possibilities we will be unlocking with the CitaDAO project that you will never have access to, holding real title deed in real life, in the real world, dealing with the banks and traditional financial institutions of today.
That sounds very interesting, especially in light of the barrier of entry to get into the real estate world is so high. For example, in the location I'm in, real estate is quite expensive. And if you're interested to get in, spending $1 million, you can only buy right now one full piece of property, pretty much, I guess, unless you are part of some sort of investment group or corporation. But if you want to invest in property, let's say $1 million might just get you, a piece of junk house. And you might not necessarily you'd rather spend your $1 million in a more high quality property where you only have fractional ownership than having your $1 million in something that you don't even like or think will appreciate in value. So there's a lot of unlocks here.
Precisely. That's the point, right? Imagine, and that unlock is made possible by the composability of the DeFi universe, because in Web3 we are a collaborative community. We work with each other to increase the use cases of what we are creating. Unlike in the traditional world where the banks are just competing against each other, my product cannot be used on your platform, your product cannot be used on my platform, and it just doesn't make sense to me. I mean, coming from that universe, I find that the Web3 space will be a lot more progressive than what we have today in the traditional finance world. And one other thing, I guess, since we're talking about what problem CitaDAO is going to solve, I guess one interesting aspect that we could talk about here, especially that's relevant to the DeFi community, is the topic of inflation. Today, in the crypto portfolio, you have the choice of your native tokens, which can be potentially very volatile, but very high returns, or your stable coin, which effectively get exposed to the inflationary pressure, given the printing machines being run wild by the governments around the world. And that's very unfortunate because unlike the real world where you usually have asset classes like real estate that you can hedge your inflation risk with, that opportunity currently still do not exist in the DeFi space. And we believe that with the CitaDAO project, by introducing tangible inflation-resistant asset classes like the real estate tokens, and obviously it's inflation-resistant because it's generating real-world rental yield and capital gains. This could be a complement to any crypto degens portfolio, especially if they want to have a more stable kind of portfolio that is hedged against inflation. And obviously, most of the tokens today, they are not really backed by real assets. So there isn't a floor price. Your token could easily go from whatever price it is today to zero. Unlike the real estate tokens, that because of the two-way tokenization bridge, now you have a floor price. Because effectively, if the value of the real estate tokens fall below the real value of the real estate, an arbitrage opportunity will materialize where you could literally redeem the title deed for the underlying real estate, sell in the real world, and make a profit. So I guess these are some of the other problems that we could effectively be solving with the CitaDAO project.
I have this image of the future where you go into the coffee shop and you pay for your coffee and a little bit of house, and you pay for your sandwich and a little bit of dog, and then it's like everything is fractionalized, but it's backed by some sort of real life asset or some sort of valuable digital asset.
Yeah, there has been some experiment, right? The uni stocks and stuff. But I guess a pair of socks is not worth as much as a real estate.
Well, if you look at the price of the Unisocks,
that's
it's,
potentially what a real estate token price could go to. So I mean, if that could happen to a stock, imagine what would happen to real estate, right? Hopefully, it doesn't happen that way.
So you were mentioning that right now is the perfect time, or right now is a great time. It's a good environment for your DAO to start with the tokenization of real estate, the Web3 version of real estate investment. How do you? And there's also a bunch of other competitors that are emerging as well. So, for example, Realty and so on. What is your unique selling proposition, and what's your competitive advantage?
So, I guess our competitive advantage is we have the benefit of hindsight. We were able to get insights into the challenges faced by the other projects. And as I mentioned earlier, those challenges basically stems from the regulatory, liquidity, and the yield hurdles, right? And because of we are the first and only platform today that allows real estate that are on chain to be de-tokenized, redeemed. We believe we will be the first project that actually offer legitimate real estate tokens that give you the claim to the underlying title deed. And this creates a valuation parity both on-chain and off-chain that probably won't exist in most other projects out there, especially if you don't have the ability to de-tokenize. Then you will be held at the whims and mercy of whoever issued the token. That's not fully decentralized. So in that sense, I think we'll probably be the first fully decentralized platform from that. Yeah. And I guess in terms of liquidity, we have the benefit of entering of building this now when the landscape is a lot more mature, where the concept of liquidity mining is more well recognized and accepted, where AMMs are well funded and better developed, more mature, I would say. And because of this, we are able to introduce a liquidity mining program that will be able to offer rewards that are equally competitive, if not more attractive than most of the yield farms out there. And the thing is, we are totally composable. For example, our liquidity mining program is not built by us; it's built by an existing project. We just recently announced our integration with X token, and they will be providing the secondary liquidity for the real estate tokens, for which obviously is a huge plus, given that most projects today do not have that option. I mean, we have seen some of them. We won't name which one. But what happened was in those because they first of all, some of the challenges that they face is that they initially started off onboarding low value properties around 50,000 to 100,000, probably a little bit more like 200,000. But even then, there's very little liquidity that you could offer in a liquidity pool. And we have seen cases where a $200 transaction in the AMM effectively result in a 30% price movement in the real estate token. That doesn't make sense. I mean, that doesn't happen in the real world, right? So with our liquidity mining program, with quality real estate on chain, that obviously is worth more than a few $100,000. We believe that we'll be able to provide concentrated, deep secondary liquidity for real estate token holders that basically wants to realize the liquidity from their real estate token if and so they choose to for whatever reasons. So that is the second and third advantage that we have compared to the other projects that have kind of come before us. I guess the real advantage is the benefit of hindsight, if you look at it from this perspective.
This yield farming that you mentioned, is it going to look like the yield farming or the liquidity mining that we're familiar with in DeFi? For example, we're going to own some tokens representing a fraction of a house. Let's call the token House 1. You're going to pair House 1 with ETH, and then you're going to farm that and get an APY on top in the form of your DAO token?
Precisely that. So we took a unique approach to this concept about bringing real estate on chain. And if I mean, if I could show the deck, I'll be happy to show it. But given it is a voice conversation, I'll just explain it. CitaDAO and real estate tokens. The CitaDAO project consists of two sets of tokens. The platform governance native token, which is a CitaDAO token, and the real estate tokens that are unique to each property. Every property will have their own set of real estate tokens. Both the CitaDAO and the real estate tokens are symbiotic, and they depend on each other to generate value and demand. If you look at it from this perspective, the CitaDAO token is never sold and can only be mined by purchasing the real estate token. So it's very similar to how you imagine Bitcoin and Ethereum versus the Bitcoin mining machine and the Ethereum mining machine. Like why we buy a Bitcoin mining machine that costs tens of thousands, 10, 20,000, right? Because when the Bitcoin mining machine effectively mine one Bitcoin, you will have recover your capital plus 2 times profit on top of that. This is how the CitaDAO platform will work. Effectively, the real estate tokens are your CitaDAO mining machines, and the CitaDAO token is like the Ethereum for real estate. And the only way to get a CitaDAO token is to mine it by either contributing liquidity, by earning it by building composable DeFi projects that increase the use case for the real estate tokens, or by as a landlord contributing iconic or quality assets on chain for the community to ape into. But if you look at the bulk of it, if you look at tokenomics, the bulk of it is actually for providing liquidity mining. And and only by providing liquidity to the platform will you be able to farm the CitaDAO token. So why would anyone want to farm the CitaDAO platform token? The CitaDAO platform token is actually very special because first and foremost, 2% of all real estate listed on CitaDAO today and perpetually in the future will accrue towards the CitaDAO treasury. So every time there's a successful real estate listed on the CitaDAO platform, and that real estate is fractionalized, 2% of the real estate tokens will immediately accrue towards the CitaDAO treasury, which means that as more and more real estate comes on chain via CitaDAO, and as the quality and quantum of those real estate increase in value, so will the CitaDAO treasury reserve of real estate tokens. That is one reason why the CitaDAO token is valuable. The second reason why CitaDAO token is valuable is because of the composability of our ecosystem. That composability is what drives the sustainability of this platform. And with the increased use cases from all the other projects out there that will increase the value of the real estate token, we believe that it will increase the value of the CitaDAO treasury of real estate tokens too. So collectively, by owning both the platform tokens and the real estate token, any token holder will get the best of both worlds and own a portfolio of real estate assets, as well as an ability to adjust their risk profile based on the individual real estate in the portfolio. So I guess from this perspective, let's take a look at it from the lens of a typical landlord in the real world today. I buy a real estate, I collect rental income, maybe 5% a year. It'll take me at least 20 to 30 years to recover my initial capital for the real estate, assuming the price of real estate don't grow. If the price of real estate, if we take into capital appreciation and stuff, obviously the amount of years will differ accordingly. But let's just assume a simple case whereby if I'm just trying to recover the price of my real estate from the rental income itself, it'll take at least 20 to 30 years. By effectively converting real estate tokens into mining machines for the CitaDAO token, and with the CitaDAO platform token increasing in value as more and more real estate comes on chain, it is possible to actually recover the original capital I put into the real estate token in less than 5 years, depending on the price action movement of the CitaDAO token itself. And we believe that this, as we mentioned before, does increase the capital efficiency of the real estate ecosystem, because now you can actually receive your capital faster and you can redeploy it faster and more efficiently into the economy to grow the overall DeFi Web3 space.
Very interesting. I am intrigued, sir. Now, what does your project roadmap look like? And are there any upcoming events that you would like to highlight to potential investors?
So, our project, we have a roadmap. I mean, we just closed our initial builders round towards the end of September, so that was 2 months back, and we will be launching our first proof of concept in first quarter 2022 to show the community how it works. And instead of trying to explain all the legal jumbo to everyone, it's easier to just show everybody how it works and that it works. With that, we plan to, I mean, being a permissionless DeFi platform, we plan to scale rapidly to over 4 billion in AUM by third quarter 2023. And I guess in terms of one of the key highlights, we will be, it is the proof of concept that will be taking place on 7 January 2022. We plan to demonstrate the CitaDAO structure with our proof of concept. In fact, the first asset we have here is a prime retail real estate in the UK. There's master lease to a global blue chip bank that command a stable money rent. And we will use this to demonstrate the flow of funds, the CitaDAO structure, as well as our listing module. The second real estate is actually a mixed-use development in central London, Covent Garden, that will be converted into a crypto space to grow further interest from the crypto affluents. They are kind of attracted to the idea of a crypto CitaDAO. This is a space we can call our home. And we will create a community to build familiarity with our platform using this space. More importantly, this prime central space will allow us to demonstrate how the real estate tokens could be staked to gain utility access to the real estate itself on the CitaDAO platform. So instead of just using the tokens to and to hedge your crypto portfolio, now you could literally potentially use the real estate itself, right? And once these are established, we will be proceeding with a beta launch to scale the user base by leveraging our pipeline portfolio of over 250,000 square feet across its project with a total value of 200 million. This is all owned by the high net worth family office that I mentioned earlier. And because of that, we have flexibility in how we want to launch this. Yeah, so that is our timeline as well as the key milestones to look forward to. Yeah.
And you mentioned earlier about your token. Do you have a token ticker name yet?
We do not have a token ticker name yet. We will be announcing the token ticker name very close to our TGE event to protect our community. With the current the current scams around out there today, we believe that it's not wise to release the token ticker name until we are close to TGE.
And what's your tokenomics like? How's this token going to be distributed? You mentioned also the liquidity mining rewards. Is there any other considerations that you have in mind?
So the majority of first and foremost, the CitaDAO token will not be sold. So if anybody is asking you to participate in an IDO, IEO to get a CitaDAO token, don't do that. We are not planning to sell the CitaDAO token. The only way to get a CitaDAO token is to earn it by contributing towards the CitaDAO project. The CitaDAO tokens, 90% of it will actually be allocated towards building the community. We have about 40% of it that is allocated to liquidity incentives. 15% of it will be allocated to community incentive, including building to avoid grants to incentivize the building of composable communities and other DeFi projects to increase the use cases for real estate token. We have 10% allocated to Rebig Treasury that will be allocated to landlords that offer quality real estate on chain for the community to participate in. And we have about 15% allocated to the team and 10% for the foundation. Most of our in fact, short of the liquidity incentive and the community incentive, all our tokens have very long vesting period. In fact, the team have a vesting period of 4 years with 1 year cliff. Our landlords have taken to committing to lock the tokens for 4 years. And yeah, the builders who contributed towards building resources towards building the POC will be locked for at least 18 months.
When we were discussing issues that happened or things that occurred in 2017, 2018, you mentioned some previous challenges. Do those challenges still stand right now, or are there new challenges, unique challenges, and how do you guys plan to resolve them?
Well, the challenges still stand right now. To be honest, I mean, the regulatory challenge will always be there. And even though we actually build our structure under the existing legal framework. There is no stopping governments around the world from moving the goalposts and changing their regulations. So I guess that regulatory hurdle will never go away, and it's important for us to always keep 1 or 2 steps ahead, to ensure that we are always regulatory compliant. But more importantly, I guess it is to be socially responsible. We believe in building a long-term project. We believe that this will make a difference to the DeFi community as well as the real world. And for this, I guess we will have to continuously ensure that our moral compass points the right way, and that members of the community are guided to build in the best interest of the real world as well as the crypto community. So those are potentially some of the challenges that will exist perpetually. In terms of the liquidity challenge, I guess the DeFi community has matured a lot. In fact, the overall crypto community has matured a lot. We have about 3 trillion in the system today, and as we grow, as more and more channels get approved by the various governments around the world to bridge the crypto space with the real world space, we will start seeing more institutional money flowing into the crypto world, and that could potentially help by itself naturally overcome the liquidity challenges. The landscape has changed, as I mentioned earlier. Today, AMM, liquidity pool, the concept of yield, these are all widely adopted within the DeFi universe. So I guess that is probably one of the challenge that has been resolved. And in terms of yield, I guess it will be twofold. One, we believe that the current yields on chain are not sustainable, at least those that are being generated by native tokens. Even some of the more prominent projects have seen their yields, the APY drop from a few 100,000 to 4 digits, right? And we will continue to see that trend happening. And we believe that because of that, there will be more and more institutional money that will be constantly sourcing for quality productive assets on chain. And we believe that real estate will be positioned to uniquely deliver the supply for that value proposition. And because of that, I guess that by itself, that challenge will resolve by itself.
And what about securing the smart contracts for your users? How do you ensure platform security?
So we do have audits in place, and we are very selective of our auditors. I mean, our current auditor is ABDK. So for those who are familiar with it, they are one of the OG auditors that have been around since the early days. And for the other auditors that we are currently looking at to bring on board, we will be we do some duty, so we don't onboard any auditors. Most of the time we do background checks and obviously a quick scan of the web pool to make sure to see how often their names appear there, and the reason for their names appearing there. It's not always the case that they appear there because of any problems of their own. Sometimes it may be because of the protocol itself, not so much the project itself, in which case we will make a decision whether to proceed with appointing those auditors. So that is how we kind of ensure the security of our project. Smart contract. In terms of ensuring the security of our user funds, our IRO take place only over a limited period of times. The IRO, which is the process where we introduce real estate on chain, whereby the commitment gets collected to convert into real estate token, typically takes place between 5 days to maximum 30 days. And that's the period of time where the funds are actually locked in the smart contract. So obviously, by having a time lock factor here, effectively it kind of limit the attack vector for vulnerabilities for our smart contract. Yeah. And I guess one of the more important things that we do consider to protect community is selection of chain that we are building on. Some of the chains, we have been studying cases, and we've seen examples of how the choice of chain does matter when selecting when protecting the community interests. To give a case in point, there was one of the more prominent hacks that happened earlier this year, where 2 billion TVL literally dropped to zero. If you look at the project itself, the tokenomics, the code base, everything, they are sound, literally. But what happened here was the chain was unable to scale up. It got congested, leading to, and obviously it was congested because the hacker was actively spamming the chain, and by sending a transaction to his wallet all the time, and that's made possible because the chain cost, the transaction cost of the chain is literally nothing. So what happened was that at the end of the day, it resulted in the attacker being able to unpack the peg for the stablecoin. It's a stablecoin project, which led to the collapse of the algo stablecoin project and lots of money lost. And if you look at it, is it the project to be blamed? I would say not entirely, because if you do a breakdown into the detailed analysis of why that even happened, it is precisely because the chain that it was built on was not built for scalability, even though it offered cheap transaction costs, resulting in the chain being gamed, which compromised the project. So the selection of chain is important for us, and we protect our community by building on established chain such as Ethereum. And even if we select layer 2 chain, we will do a chain analysis literally before we deploy onto those chain.
Very nice. And regarding the properties, are they on a triple net lease?
The thing about it is that the real estate, I do not really understand this question. Are the properties on a triple net lease? Are you referring to the tenant, or are you referring to the title deed of the property itself?
I actually have no idea. I didn't write this question, so we'll skip this one.
I mean, okay, I'll answer both. Right. The simple answer to this question is it can be, and it doesn't need to be, because we are permissionless platform. So any landlord can list their property on chain for the land. Any landlord can list the property on the platform for the DeFi community to participate in. So if those property that are listed are a triple net lease property by way of a title deed, then it is a triple net lease property. If it's a freehold property, it is a freehold property. Our first POC is a freehold property. The bank building is a freehold property, so there's estate in perpetuity. So that is the for the POC concept, that will be a freehold property title deed. In terms of the lease, the tenure, it also depends on the landlord when they lease the property. If they lease the property with a tenant that pays triple net lease, that's good. If not, typically it should be rebased to a triple net lease kind of number in order to enable easier comparison. For our first POC, it is on the triple net list. The bank building the first POC, the first IO that we'll be launching is on triple net list.
Okay, so the DAO in the future, I imagine having quite a few property holdings, and it's going to be decentralized. But how will that property itself be maintained? Is there some sort of separate fund that will be designed for the upkeep?
So there will be a professional property manager that will be appointed. These property managers will be the likes of your CPI, JLL, Cushman, Savills, for example, and they will be in charge of doing everything from sourcing the tenant, securing the tenant, to maintaining the property facilities management, so on and so forth. And we do not plan to do this via DAO, because as anyone in the real estate space will know, property management for real estate is a very specialized skill set. To manage industrial property is very different from managing an office property. It's very different from managing a hotel. It's very different from managing a retail property. And it doesn't make sense to actually start hiring all those people within the DAO. It makes better sense to actually appoint a well-established, well-trusted third-party property manager to manage the property.
And how often is the value of the properties appraised? And how will investors be informed about that?
That's a very good question. In fact, we are very excited to announce our Chainlink integration today. We have integration for Chainlink, whereby we will be the property SPV will be appointing valuers, at least two, if not three valuers, to provide monthly valuation of the real estate in the real world. And that valuation, the average of which will be picked up by the Chainlink Oracle, and kind of released on chain for other DeFi projects to leverage on to build their own use cases for the real estate token.
Very cool. And now something a bit more maybe boring, but the red tape. Now, how will the CitaDAO team deal with cross-country regulations? For example, a company incorporated in Singapore, but the properties are in the UK.
So cross-country regulation is a very I mean, okay, so when you talk about cross-country regulations, what are you talking about here? If you're talking about ownership rights of the underlying real estate, we have to validate that the location where the SPV is incorporated have the ability to actually own property and own the legal title deed in the country that the property is domiciled in. In this case, for example, Singapore, UK is an open market. Anyone around the world could own a property in the UK, and there is no issue with Singapore SPV actually owning a property in the UK. Obviously, this differs from country to country. For example, if we were to look at, I would say extreme case will be China, for example, whether a SPV that is not domiciled within the city, not even within the country, but within the city, has the ability to own the real estate. That might require a little bit of structuring. It may not be so simple. But typically in those cases, we will actually deploy the best practices established in the private equity real estate space to set up the structure to own those property. Therefore, for the beginning, at least for POC round, we will only be doing Commonwealth countries. We will not be expanding outside the Commonwealth countries until we have established first the proof of concept, and second, the relevant legal regulatory structure that has been approved by lawyers to enter into those countries. Yeah, so that I guess should help answer the cross-country regulation.
About the tokens and their liquidity, could the tokens be sold back to CitaDAO, and will the team create a pool on a DEX for trustless swapping of the tokens?
The team, so okay, when you, which tokens are you referring to here? Are you referring to the real estate token, or are you referring to the CitaDAO token?
Well, you mentioned earlier that the CitaDAO token will not be tradable. Is that correct?
No, it will not be sold, but it will be tradable. Yeah.
Okay.
So our plan is to, so what we have here, the real estate token we have issued, we have received a legal opinion that the real estate token is not a security token. But this is this is quite subjective depending on which jurisdiction you're in, right? So for this real estate token, it will only be listed on a DEX for trustless swapping. For a CitaDAO token, it's going to be unique because one, it was never sold to anyone, and two, there's no expectation of profit. Basically, for a CitaDAO token, you are effectively just earning it, farming it, and receiving it from your contribution to the building the project. So this could clear a higher bar, and we plan to get. We have already received a legal opinion, obviously, for CitaDAO token that's not a security token. While we plan to get another legal opinion issued by a US lawyer, and hopefully with that, we do have intention of listing the CitaDAO token on centralized exchanges on top of that also.
And to participate in the first IRO, is there any whitelisting process, or is it open to everyone? What's the situation?
There's a wait list, so we invite everybody to submit their details to be kept informed of the first IRO. There's no whitelisting for the IRO property itself, but there will be a whitelisting of addresses for a bonus CitaDAO airdrop token. So for those who are part of the early adopters who believe in us, who help us build a project earlier, and who sign up for the wait list on the website, you will be informed of the whitelisting when we launch the whitelisting process. It won't give you early access or any privilege to the IRO. That's a fair launch. The real estate launch is a fair launch, but it will give you additional benefits such as NFT airdrops and additional bonus CitaDAO token that could prove to be very valuable.
There you have it, guys. That is the alpha of the interview. Amazing.
Yeah.
Amazing. Now, for those who don't know what IRO means, that's initial real estate offering?
No, that's we don't call it initial real estate offering. It literally means introducing real estate on chain. Because that's what we are doing. We will be the first project that will legitimately introduce real estate on chain, and because of that, we call it IRO.
Okay. Now, have you guys considered paying out the rental income in a stable coin instead of using the rental income to buy back the tokens from the market?
No, that cannot be done for a very simple reason. The moment the rental income is used to pay back to the token holders, the real estate token will be classified as a security token. And if you weigh the benefits of being classified as a non-security token and the liquidity it will unlock by being listed on the DEX, it doesn't make sense to actually sacrifice that for that status by paying back the rental income in stablecoins. Plus, not everybody wants to receive their rental income back in stablecoins, because then you have to start deciding how you're going to deploy it. I mean, it's good if you receive thousands or hundreds of thousands, but if you're receiving like $10, $20, that's kind of messy. Yeah.
What about potential tax issues? How will those be managed?
So tax issues will be based on the local jurisdiction which the real estate is located in. Obviously, the rental income collected, so on and so forth, will be subjected to your typical corporation tax, income tax, and whatsoever. And you'll be managed by the professional company sec and accountant that is employed by the SPV. In terms of the SPV tax, we will always find the most tax efficient jurisdiction to base the SPV such that the income received from the property will not get subjected to double taxation or even more taxation, right? Because we are not distributing the rental income back to the token holders, we do not have to look into cross-jurisdictional dividend tax distribution. So that is one advantage of our structure that we managed to avoid by effectively redeploying the rental income to buying the real estate token. We effectively avoided that issue.
And what types of properties is CitaDAO looking for? Residential, office, malls, industrial?
We are a permissionless platform. The team do not curate the property. The community will curate the property on the platform. So effectively, any kind of property can be listed on the CitaDAO platform. Office, malls, industrial, hospitality assets, hospitals if you want to, data centers, so on and so forth. The only one as a class that we will restrict from coming onto the platform, at least until we have a better insight into the impact of the platform in the real world asset prices, is residential property. Being a socially responsible platform, we do not want to inflate residential prices around the world because that does affect the livelihood of many ordinary citizens, ordinary people. And until we have better insights into how we can mitigate any abnormal price inflation in the real world, we will only be restricting residential properties to participate on chain. Otherwise, all other kind of real estate, the landlord will list it, and the community will decide whether they want to make the listing successful. If the community decides that they want to make the listing successful, then the property will come on chain, and effectively that's why the community decides in a nutshell.
Pretty much what you've mentioned so far is the tokenization of individual properties, but do you have any plans to build or bundle a bunch of properties into a kind of index, ETF, or some sort of structure like that?
So yeah, we are very excited to actually share that we are currently in discussion with Index Co-op to explore that possibility. Building up indexes, building up REITs and ETF is not a core expertise that we want to focus our resource on. And we have more established, better DeFi protocols out there that have a community of talents that have successfully launched product that know how to do this better than any of us. And we believe in the composability of the DeFi community. So we are actually exploring collab with Index Co-op to create an index of real estate tokens on chain. And in fact, given that most of our real estate right now in the pipeline are UK-based properties, they could effectively potentially even look at releasing a UK index token, a UK real estate index token for our first beta release. And I guess in the long run, we will imagine that anyone and any DeFi protocol with the expertise and capabilities will likewise be able to create their own independent real estate indexes. And if they are good at it, I believe the DeFi community will probably ape into their indexes. So that's something we believe in, a collaborative community, and we'll be working with other DeFi projects to make this happen.
It's funny you mentioning that people are going to be aping into this, because tying back to something you mentioned before, if you create a real estate investment trust or some sort of index with the Index Co-op, and with the composability that you mentioned, it's possible that this index won't just follow the UK property averages. It'll actually far exceed that, because these properties will be actually more valuable due to their ability to yield farm and be composable with other DeFi applications and so on.
Potentially, you're right on. And that's how
Very
we increase capital efficiency in the real estate universe on chain.
Okay. And how does this offering fare when compared to equity real estate investment trusts? And what features do they have that other REITs lack?
So, coming from a real estate background, I would say that real estate investment trusts, or rather equity real estate investment trusts, are predominantly products of yesteryears. They were dominant when securitization was all the hype, but they are obsolete in the tokenization era. And real estate investment trusts themselves come with their own sets of problems. I could name a few. I guess the one of the most frustrating one that I've seen in the market is how there's an outsized authority given to the principal, rather the agent, which is the REIT manager. These REIT managers typically do not. I mean, they are typically supposed to act in the best interest of their equity holders, of the REIT token holders. Of the REIT subscribers. And in general, for most of the time, this happens, right? But we have also seen instances where the managers abuse their authority to kind of increase their fees, because their fees is based on the AUM of the REIT at the expense of the REIT holders. To give some case in point, right? We have seen cases where the REIT managers will enter into discussion with landlords to effectively do a sales and leaseback scheme with the landlord. Now, for most REITs out there, there is a control check process in place, which means that the REIT manager will not be able to acquire real estate that is generating a yield that is lower than the average yield of the REIT. And that's supposed to be a control check to make sure that every single real estate, the REIT manager bring on board is yield accretive, and to force the REIT manager to source for the best real estate in the market. However, we have seen instances whereby the REIT managers would enter into a sales and leaseback scheme with the landlords, whereby they will offer to buy the real estate at an inflated price with the promise that the landlord will lease the property back from them at a higher rent that will clear the minimum yield that they need to acquire the property. And usually when that happens, there's nothing the REIT holder could do about it. I mean, you could see, you know, that they are bringing on board shitty properties, and they are doing that so that they can increase the AUM of their fund size of the REIT so that they can pay themselves higher fees. But there's nothing you can stop them from doing. Like literally, you are held hostage by them. And if let's say you try to be an activist investor and you try to raise some concerns and so on and so forth, the typical approach, and this has been seen even in cases that were brought before the courts, that the REIT holder will be told that, look, if you do not like the REIT, you just sell it, sell the REIT token, right? Yeah, and if you think about it, that's not fair, because I mean, I invest in this portfolio. I believe that the REIT manager should act in the best interest of myself, and I believe that the REIT manager should always be on the hunt for better deals, better properties to bring into the portfolio. But at the end of the day, I mean, I guess because of this principal agent issue, due to the centralized nature of most REITs, it can't be avoided that these instances happen. Not very often, but it does happen, and there's nothing that you could do about it if that happens to you. For our CitaDAO platform, because of our decentralized nature, and because you have the ability to participate directly in the underlying real estate itself, you can always choose if you want to get exposure to this real estate or not, without having to rely on a centralized agent that may not always act in your interest. And the ability for the community to decide by voting during the IO process, meaning depending on whether you commit sufficient to bring the real estate on chain, means that only quality real estate will be brought on chain, and the power to decide which real estate to bring on chain for the community to get exposure to will reside with the community itself and not with a centralized REIT manager. And I guess that is probably one of the biggest challenge I see the REIT of today faces, that our project will help overcome.
I have one last question before we open up to audience questions, and that's the metaverse. Do you guys have any metaverse plans, or have some sort of roadmap to integrate digital properties?
We do have plans for that, but our current strength is building the real estate in the real world into the metaverse. Literally bring real estate on chain, bring mid-space real estate on chain. But I would imagine that in the future it'll be very exciting if we can create metaverse projects that are backed by physical real estate in the real world, that you could experience physically while enjoying the benefits of the metaverse. So that is something that we are very excited about, and we do have plans to look into that. But for now, the team is focused on and razor sharp focus on getting the first proof of concept through, to establish trust in our platform, to establish legitimacy for our real estate token, and to show the community what can be done with real estate on chain.
Thank you very much. So now the floor is open. If anyone in the audience has any questions, you're free to unmute yourself and ask.
Yeah, I have a few questions. Caesar here. First of all, I heard you say something about like the CitaDAO token being able to be redeemed or something back to the real estate token. So you could go backwards and you can actually get like the real estate. Can you talk a little bit more about this? Like, based on what I understand now, the CitaDAO token's only use would be to just go up in value by the rental buybacks and maybe some governance ability to choose which properties are allowed to be listed or tokenized. So is there some sort of redeem feature for the CitaDAO token?
Okay, so to clarify the point, I think there's a bit of a misunderstanding there. The real estate tokens itself have to be used to redeem the title deed of the underlying real estate. You cannot use the CitaDAO token to redeem the underlying real estate.
Okay, can you redeem the CitaDAO token for real estate tokens? Like what? Like, can I somehow interact with the protocol and give up my CitaDAO tokens for a piece of the treasury?
No, you can't. You can't. You
Okay.
can't redeem the CitaDAO token for the real estate token. You have to you have to sell it to realize the value.
Okay.
Yeah.
Okay. Do you have any idea, like any plans? Like, there's quite a few hacks. I'm not saying you're going to get hacked, but there is a lot of hacks, and maybe some real estate tokens are on another protocol. You're doing DeFi Lego stuff, maybe on a lending protocol, and that protocol gets hacked, and now your real estate tokens are in the hands of exploiters or hackers and stuff like that. Do you have any like freeze functions, like centralized stable coins, USDC, USDT, they can freeze the token and stuff like that to kind of protect that actual piece of real estate from getting into the wrong hands in this way?
We do not have that for the real estate tokens. We are a decentralized platform. But what will happen is that the hacker effectively also cannot redeem the underlying real estate, because if he's going to try to redeem the title deed with the real estate token, he will expose himself. He will have to.
Okay.
Yeah. So he won't. The only thing he can do is to sell it, and obviously, if he tries to sell it to anyone else, he can be traced and tracked down.
I see. So in order to redeem the real estate tokens for the underlying share of the property, you need to do KYC then, right?
Yeah, you have to go through an AML KYC process, because you are going to transfer the title deed of the real estate into your name, which means you need a lawyer, and appointing any lawyer will require you to go through an AML KYC process.
Yeah, of course. Okay. Now, since a piece of property, let's say there, like right now, you have some commercial properties in the pipeline in London or somewhere in England, right? Are there obviously going to be quite a few tokens for one piece of property, right? And I assume each property will be able to decide like, well, how many tokens I want to allocate to this piece of property, regardless of the value of that property. Is this correct?
We will be issuing at the IRO one token for $1 worth of the property. And for a good reason. It allows for it allows for easy comparison across multiple assets, because if the IO price is $1, if your token price subsequently trade at $1.15, you know that it's 15% up from the initial IO. If it's trading at let's say it's trading for 80 cents, you know that it's 20% down from the IO. So it allows for easy cross comparison across different real estate.
Okay.
So IO launch price.
So if the actual capital value of the property goes up, it won't affect the token's not going to rebase or something like that, right? It's just going to the supply is fixed, right?
Yeah.
Okay. Yeah, there's some more. Yeah, I think that's about it for me.
Cool.
Yeah. That's it. Yeah, for me. Anybody else? I've got some more, but I have to brainstorm them back.
Yeah, I mean, anytime, right? You can always ask us on our Discord, or you could always ask us on the Creator Discord. We'll be more than happy to answer.
Oh, actually, I do have one. I thought of something else.
Okay.
Is there any, like, based on what you're just saying now, that since each token is going to be launched at $1, then two different properties, let's say property one, we'll call property A and property B. So then you'll have real estate token A and real estate token B. These tokens are not fungible. They're unique in they'll have their own contract addresses, right? But is there any kind of way to like actually be like, oh, I don't really want to be in this property? I guess they just trade through the market. Yeah, never mind this question. But that is clear though, right? Like there's no fungibility between property and property, right?
There's no fungibility between two properties, but the real estate tokens are ERC20 fungible tokens.
Okay,
That
so
is specific only to that property.
Okay, so there's no ability to choose any kind of section of a property, like the third floor of this building. I want to buy that.
You can't unless you strata title that third floor. It has to have a title before you can issue a token.
Okay.
Because it has to be tied back to a title deed that you could legitimately reclaim.
I see. Yeah. I get it. Now let's say I were to. This is a real estate question, I guess, more than a cryptocurrency question. Let's say I were to buy. Let's say a property was worth, I don't know. I'm just gonna throw a number out there: 2 million pounds, right? And I came along with like 600,000 pounds, and I bought 600,000 pounds worth. How could I redeem that for like a piece of the property? You know what I mean? Like, how could I be like, oh, I want to redeem these real estate tokens? And I'd have to buy the entire bag, wouldn't I? In order to get a hold of them.
You have to buy out all the other real estate token holders in order to redeem the title deed. Yeah, and the reason for that is simple, right? I mean, it doesn't make sense to go and try to hack away one brick or
yeah. Again.
I mean, yeah, and you wouldn't want to hold a fraction of the real estate itself. Like there's no use case. Like what are you gonna do? You're gonna squat there?
Exactly.
Yeah. So it doesn't make sense from a utility perspective. Yeah.
Okay, that makes sense to me. So do you have any plans to kind of make some sort of OTC system so that like it's impossible to like drain the liquidity pool. You know, like if the real estate tokens trading versus ETH on Uniswap, there's no way I can get them all out of there. The price will just go to the moon, right? In order for me to ever try to get all of those real estate tokens out of there.
We have this thing called a buyout provision. So back to the two-way tokenization bridge that we mentioned earlier, right? The two-way tokenization bridge is there to ensure that there's a floor price to the real estate token, such that the real estate token in the real world will never fall below the real estate token on chain will never fall below the price of real estate token in the real world, and that's what the buyout function is meant to do. It's mainly there to secure. It was never meant to be actually used, because unless there's a black swan scenario, because in ordinary times the real estate value on chain should always be higher than real estate value off chain. Okay, so back to the point, right, about it going to the moon, right? The buyout protocol works this way. Anybody with a real estate token effectively have the right to buy out everybody else, all the other real estate token holder for that particular real estate. And the way to do that is they will have to initiate this thing called the buyout protocol. What's going to happen when they initiate the buyout protocol? First, your real estate token that you have in your wallet will have to be deposited into a smart contract. You will have to also dictate the price that you intend to buy out everybody else at. That price will be multiplied by all the outstanding real estate token, and you will have to deposit the USDC equivalent into the same smart contract to be locked up during this buyout period. Once you have fulfilled both of these conditions, all the other real estate token holders will be notified of an ongoing buyout process and the price that you have offered to buy them out at. At this point, they have a decision to make. They will have to decide whether they're going to accept the price that you're paying for the real estate token, or if the price is too low, to buy out your token for the price you're offering to buy out everybody else at that same price. If they decide that the price that you're offering is too low and they want to buy out your token, they will be able to collectively set up a counterclaim pool whereby they can pool together their resources to effectively buy out your token at the price you offer to buy out everybody else at. And when that happens, effectively you lose your token and you no longer have the right to buy out everybody. If, on the other hand, nobody puts money into the counterclaim pool, or there's insufficient funds raised in the counterclaim pool to buy out your token at the fixed price that you set to buy out everybody else at, then the buyout will be successful. You will be able to claim the NFT. They give you the right to the underlying real estate. And basically everybody else will go to the same smart contract and exchange their real estate tokens for the USDC that you have locked up in that smart contract.
Okay, this makes sense. So if somebody's not paying attention, they're just holding tokens, or the token's locked away in some smart contract and forgotten about it, then there's a chance that that token will become not valueless. It will become a share token for some USDC or some stablecoin sitting in another contract waiting to be claimed. Okay,
Yes.
okay. That's interesting. That's clever. I like this.
Thank you.
Okay, that's it for me. That's it.
But
Thanks.
to add on that structure about buying out, it is not a brand new sort of innovation that we came up with as well. I think there's a few other NFT fractionalization project has the same or similar. I wouldn't say same. We did do some modification to it, but it was similar.
It's tried and tested. It's proven. So the community is familiar with it. It's just that for us, we'll probably be doing it at a much larger scale, given that we're talking about real estate here.
Yeah, commercial real estate too, right? Or at least high value real estate.
Yeah.
I do understand. You answered my question. I had another question about like retail and the whole idea of like credit for low value people, like people wanting to buy a home, but they need a mortgage because they can't afford to pay the whole thing. But your answer about the trying not to manipulate or have an effect on price homes, because if everyone's home becomes a DeFi asset, then you are in fact, they have the power to increase the value of everyone's home and therefore pricing a lot of people out of buying their first home, right? So I
don't want to do that.
Okay. Yeah, I don't have any more questions. This is a very interesting project.
We do have an IRO coming up. I think that IRO is something that we encourage you to look into. It is going to be very exciting. Imagine today in the real world, you have to wait like maybe 20-30 years to recover your capital. For this IRO, Genesis IRO, we are going to offer a very irresistible package that could allow you to recover the capital you deployed to buying the real estate token in less than a year.
Yeah, that sounds nice. Of course, man. Getting back your cap, and then of course you're still holding the real estate token, right?
Yeah, of course. Yeah. So now you're a landlord. Yeah. And the best thing is you're going to be the lord of the bank. Sorry.
Yeah. Okay. Bankless. Okay, yeah, I'm good.
So there you have it. Caesar approves. Not financial advice. Anyone else have
Definitely
any
not financial
questions?
advice.